those existing home sales numbers are just crossing the wire now. A lot of apprehension ahead of those figures as they cross. I'm joined here by economics editor Mckee. Mike, what are they?
The apprehension totally justified. A 27% decline. We were expecting a 13% decline. The annual sales rate, 3.83 million. The consensus was for 4.65 million. Of course, we saw futures go down before the number came out because the whisper number on Wall Street was for something like we got. If you look at local real estate numbers from around the country, you saw declines of 20 to 40% in the month. So this is not a surprise to people who've added those numbers up. Taking a look at the total sales month supply, we're at 12.5. That's worse than I think we saw during the worst of the recession. Now, that's how many houses are for sale at the current sales rate, which is obviously pretty terrible, but it is not good news at all. So overall, total sales down 27%, single-family sales down 27%, condos and co-ops off 28%.
And as those numbers crossed, you said futures were down. Look at the market now. NASDAQ down about 2%. We're down at 1.8% on the broad market, 1048 right now. Dow Jones Industrial Average just trading above that 10,000 mark. And before the session, we had seen buying of yen, buying of safety. You saw that reflected in where the Treasury note was. Right now, the 10-year note yield has fallen below 2.5%. We have seen a real reaction right away to those figures as they crossed. As Mike just went through the detail, there is a lot of apprehension and perhaps justified. I want to bring now from some more perspective into this conversation. Joseph Brusuelas is with us. He's a Bloomberg in-house senior economist. We've sort of breathlessly gone through the numbers here. We were essentially discounting everything but the end of the world this morning.
Right.
What have we gotten?
We got darn near the end of the world. You know, this is some very grim data. We saw a cyclical low in total sales and a cyclical high in month supply. What was interesting is the median price only moved marginally down. That was probably because we've seen a lower share of first-time home buyers, meaning the people who bought homes were, not first-time home buyers, and they tend to move up. This will only be temporary. That median price is going to fall. I think the more important thing here we want to follow is the share of short sales and foreclosures here in the overall number. The more short sales, the more foreclosure sales become a larger percentage, the more likely it is that median price will fall. It'll hurt consumer confidence, and then will show up in consumption in a couple months.
And it's jobs and it's those foreclosure sales that are sort of capping us out here, it sounds like, is what you're telling me.
Yeah, and you're right. This all comes back to the unemployment rate. The housing numbers are not going to improve until consumers see or observe a sustainable decline in the unemployment rate, or we get some policy moves, which I don't think are really on the table.
This is the worst sales month in terms of rate since 1995. You have to figure, though, that it's not really sustainable at this low level because just the base level of demand is going to be higher than this.
Well, that's right. And again, I think that we can look at this total sales, but what we got to focus on is the composition of the sales, short sales and foreclosures. That's what's going to hurt the median price, and that's what's going to hurt the economy.
Yeah, we're looking at the Dow Jones Industrial Average right now, just still flirting with that 10,000 level. See if we'll maintain. Obviously, we'll keep an eye on some of those technical levels on the Dow and the S&P and whatnot, and get you to the floor of the exchange in just a moment. But I want to introduce the next thing here, because whenever we get a data point like this, it brings us to Jackson Hole, what we might hear from the Fed chairman himself at the end of the week. How do you spin this in a positive way? How do you say the recovery is still going if we're not seeing a build off of that government tax credit at this point?
Well, you can't at all. All you can say is that you maybe think that the housing numbers are affected by the home buyer tax credit that pulls sales forward, and we should see on a demand basis a little bit of demand resuming as we get into the fall. Also, housing is fallen so much that at this point the damage it does to the economy is much lower than it has been. And of course, with existing home sales, you don't have as much contribution to GDP as you do with new home sales. You're not building the houses. Maybe people refurnish them. So maybe Ben Bernanke on Friday sort of ignores this number as a specific data point, just talks about the economy slowing overall.
Right.
The question is really, what does he suggest the Fed is going to do about it?
And that cycle, though, I mean, in terms of talking about how insulated that those price declines may be, then you get to how significant the home is to the consumer's own personal net worth. And it leads us into what's happening to that engine of growth. Where is the consumer?
Well, the consumer's on the sidelines and is not in a position to support the recovery. I think when the Fed takes a look at this data, Mike's right. The Fed's largely going to ignore it. They've got bigger problems. Mr. Bernanke's got a fairly significant split. If it's not a two-way split, I actually think it's a three-way split on his own committee. And among the Fed presidents, he's probably going to want to introduce the notion that the Fed is ready to take steps if deflation breaks out, not necessarily having to do with bad home prices or another bad quarter of a consumption. It's deflation that they're worried about.